What's up? Today we're doing EQT Corporation, America's biggest natural gas producer in Appalachia. And this one's different, because the headline revenue number in this report is actively lying to you. I'll show you exactly how. Quick disclaimer, not financial advice, purely education. 10 sections, let's go. Section 1, the big picture. Who is EQT, and why does its own research report open with a warning label? The numbers. Market cap about $35 billion. Stock around $52.50. Revenue last year, $8.6 billion, up 71%. P of 9.4, which is cheap. EV to EBITDA under 5, which is really cheap. But look at that gray box underneath, the report is literally warning you not to trust the revenue number. We're coming back to that. What do? They drill natural gas in Pennsylvania, West Virginia, and Ohio. But here's the twist that makes them different. In 2024 they merged with a pipeline company, so EQT now owns both the wells and the pipes that carry the gas to market. In the industry, drilling is called upstream, pipes are called midstream. Almost nobody owns both. EQT does. Why does that matter now? Management counted more than 45 projects in Appalachia: data centers, factories, electrification, that could need nearly 20 billion cubic feet of gas per day. They also signed their first LNG export deal starting in 2028, which lets them sell gas at international prices instead of just American ones. The headwind? Gas prices are weak. Around $2.89. The rivals. Antero has natural gas liquids, which cushion them when dry gas prices fall. Range Resources is efficient but about a quarter of EQT's size. And Coterra has Permian oil to smooth out the bumps, which is why it trades at the highest PE of the group, 14.5. Notice the pattern, everyone else has something that isn't dry gas. EQT basically doesn't. Now watch this table, because this is the whole trick. Last quarter revenue fell 29%. Net income fell 73%. Sounds like a disaster, right? But sales volume, the actual amount of gas they sold, came in above the high end of their own guidance. They sold more gas and reported less revenue. Both facts are true. Hold that thought for 2 minutes. And the report's 3 risks explain it. 1. They're a price taker, they don't set the price of gas, the market does. 2. And this is the big one, hedge accounting makes reported earnings swing violently, so headline results are a poor guide to the actual business. 3. They depend on new pipelines getting built on time, which isn't fully in their control. Section 2, the report card. They reported on July 22nd, and it was a genuinely weird quarter, good and bad at the same time. Revenue beat slightly. Earnings per share missed 39 cents versus 42 expected. But sales volume came in above the top end of guidance, and they raised full-year volume guidance. Management confidence, 4 out of 5. So, missed on the money, beat on the gas. 5 takeaways, and takeaway 2 is the one that made me sit up. They raised full-year volume guidance by about 90 BCFE, that's a measure of gas quantity, and they cut capital spending by $25 million. More gas, less money spent to get it. Companies almost never move both of those dials the right way at the same time. More detail. Wells are running about 8% ahead of their type curve, that's the predicted production line an engineer draws before drilling. Beating it by 8% means the rock is better or the technique is better. And net debt dropped from $7.7 billion to $5.5 billion in 6 months. That's $2.2 billion in half a year, which triggered a credit upgrade. The report notices something sharp here. Management deliberately steered attention away from the earnings miss and toward volumes, capex, and the balance sheet. Now, that could be spin. But the report gives them credit for one line in particular: growth should follow contracted demand, not growth for its own sake. In an industry famous for drilling too much, that's a real discipline signal. What's next? Q3 results in late October, which tests whether that raised volume guidance holds. Whether the new pipeline finishes by year-end. And the big one, whether those 45 demand projects turn from under-evaluation into actual signed contracts. That word evaluation is doing a lot of work right now. Section 3, Red Flags. And this section contains the single highest red flag score we've hit in this series. Overall, 4 out of 10, lower is better, so moderate. 0 high severity issues, 2 medium. And the top risk stated plainly, commodity price exposure. But scroll into the scorecard, because one row scores a 6. There it is. Revenue quality, 6. That's the highest single flag we've seen. The finding, quote, reported revenue includes derivative gains and losses producing wild swings that obscure operations. Plus 71%, plus 53%, minus 29%, all in about 18 months. Everything else is 2s, 3s, and 4s. Cash flow, a 2. Debt, a 2. Clean. Okay, so let me actually explain the trick, because this is the most useful thing in the video. EQT locks in future gas prices using contracts called hedges, basically insurance against prices falling. Accounting rules force them to run the changing value of those contracts through the revenue line. So revenue can jump or crater by 50 to 70% without a single extra molecule of gas being sold. The report's advice, ignore headline revenue. Watch volume, realized price per unit, and free cash flow instead. So the three critical risks stack up like this. Price dependence, no amount of operational excellence beats a weak gas market. Headline earnings volatility that can trigger sell-offs disconnected from the actual business. And pipeline timing they don't fully control. Notice that only one of those three is about how well they run the company. Section 4, the moat. What stops a competitor from taking this business? 31 out of 50. Ahead of Range Resources. Ahead of Coterra on scale, but behind on diversity because Coterra has oil and EQT doesn't. And the report says the moat is expanding, thanks to that pipeline merger. Head to head, and EQT posts 3 perfect 5s. Cost advantages, 5, because owning the pipes means they don't pay anyone else a toll to move their gas. Scale, 5, the largest producer in the basin. Distribution and market access, 5, own transmission plus that new pipeline. But be honest about the 2s, network effects and data assets. This is a hole in the ground, not a software platform. Nobody in this group scores well there. The real edge, in one sentence, EQT owns the pipes its competitors have to rent. Every rival pays a fee to move gas. EQT pays itself. Add a huge contiguous block of land, which lets them drill longer horizontal wells more cheaply, and in a commodity business where you can't control price, being the low-cost guy is the strategy. What threatens it? Antero's liquids give a natural cushion when dry gas is weak. Coterra's Permian oil smooths cash flow through the cycle. And everybody is racing to sign the same data center contracts. EQT is the purest bet here, which cuts both ways, hard. Section 5, the price tag. And after 4 sections of caveats, this is where the bull case actually lives. P of 9.4 means you pay $9.40 for every $1 of annual profit. For reference, the broad market usually runs 20 plus. EV to EBITDA of 4.8 is another expensiveness measure that accounts for debt under 5 is genuinely low. Versus peers, a 20 to 30% discount. The report's red is one word, cheap. The table backs it up. EQT at 9.4 times earnings. Range at 10. Antero around 11. Coterra at 14.5. And on EV to EBITDA, 4.8 versus Antero 7. So the biggest company, and the only vertically integrated one, is also the cheapest one. That's the setup that makes value investors lean in. 2 more data points that sharpen it. Guru Focus notes EQT's PE sits about 51% below its own historical median, so it's not just cheap versus rivals, it's cheap versus its own history. And the stock at 52.56 sits at the very bottom of the analyst range, low 52, average 67, high 79. It's trading at the pessimist's price. But be fair, why is it cheap? The report gives 3 honest reasons. Pure dry gas exposure with no oil or liquids to cushion it. Those violent reported earnings swings we just covered. And leftover skepticism about whether the pipeline merger really works. Cheap stocks are usually cheap for a reason. The question is whether the reason is temporary. 3 things to track, and note number 1, realized price per unit, not headline revenue. The report keeps hammering this. Then quarterly free cash flow against the $3.5 billion full-year projection. And net debt heading toward the $5 billion target. Section 6, Crystal Ball Math. A DCF, guess a company's future cash, translated into today's dollars. Except for this company, the report admits upfront that it barely works. Let me explain why. Bear case, $52. Base, 67. Bull, 79. Stocks at 52.56. So the bear case is basically where the stock already sits, and the base case implies about 28% upside. But read the report's own note, a conventional DCF is difficult here, because cash flow depends directly on a gas price nobody can forecast. So this tab organizes assumptions instead of pretending to have an answer. And look at the top row: realized gas price. $2.60 in the bear case, $3.20 in the base, $4 plus in the bull. That single row drives nearly everything else. WACC, by the way, is basically an impatience rate, how harshly you discount money arriving years from now. Here it runs 8 to 11%. And here's the arithmetic that made this click for me: the report flags it as its own calculation. Every 25 cents per unit on roughly 2,400 BCFE of volume is about $600 million of pre-tax cash flow. 25 cents. That's it. A rounding error on a gas quote is worth $600 million to this company. Which makes this table read differently. Bear, minus 1%, you're already there. Base, plus 28. Bull, plus 50. The downside looks unusually shallow, because the pessimistic case is already the market price. But that's only true if 52 really is the floor. And the report closes this tab with the sharpest line in the whole document. Unlike most sectors, EQT's bear and bull cases differ almost entirely on one outside input, the gas price, rather than on execution. Management controls volumes, costs, and debt, and has executed well on all three. They cannot control price. That's the entire stock in 2 sentences. Section 7, the calendar. And note, Q2 earnings already happened on July 22nd, so that catalyst is in the rearview. 8 catalysts tracked, 3 high confidence, with Q3 results in late October as the nearest one. The 6-month window is where it gets interesting. The new pipeline targeted to finish by year-end. Net debt hitting the $5 billion target, which is the trigger to shift cash from paying down debt to buying back stock. And winter, the 2026 to 27 heating season. Cold winter draws down gas storage and lifts prices. Warm winter does the opposite. A gas company's biggest quarter is decided partly by the weather. Top 3, and number 1 is refreshingly blunt, the natural gas price strip. Nothing else moves the stock as much, and the whole 52 to 79 spread basically maps to price scenarios. Then converting those demand projects into firm contracts. Then hitting the debt target that unlocks buybacks. Section 8, who's driving the bus? 42 out of 60. CEO Toby Rice scores 4 out of 5, and there's a story there, because he actually ran a shareholder campaign back in 2019 to take control of this company. CFO Jeremy Knopp, also a 4. One gap though: insider ownership isn't disclosed in the sources the report gathered. Scan the scorecard in one row stands out: guidance accuracy, a perfect 5. The reasoning: they beat volume guidance and raised the full-year number and cut capex, all in the same quarter. 4s on transparency, capital allocation, acquisitions, and communication. The 3s are mostly where data wasn't available, plus buybacks, which have taken a back seat to paying down debt. The blemishes. The earnings miss, which was mostly price-driven, not execution. And insider selling: an executive sold shares in March at about $64.49, and there was a $5.26 million sale in June. Both well above today's $52.56. The report is careful: executive sales are often pre-scheduled, but flags it as worth monitoring. No restatements or major controversies found. Verdict: long-term owners. A transformative merger, deleveraging ahead of schedule, explicit refusal to chase production headlines, and beating volume guidance while cutting spending. The stated caveat: no clear insider ownership data, alongside visible executive selling. Strong marks, with an asterisk. Section 9, Bull versus Bear. 8 rounds, 1 neutral judge. Bull takes 5, Bear takes 3. Key uncertainty, stated plainly: the natural gas price path. Which by now should surprise exactly nobody. Round 1, and the Bear lands a real hit. Bull, volumes beat the high end, guidance raised, wells 8% ahead of plan, capex cut. Bear fires back: revenue fell 29%, and quote, more molecules at lower prices isn't growth, it's running harder to stand still. Ouch. And the bear adds that last year's 71% revenue jump was substantially a hedging artifact. That's a fair punch. Round 2, price. Bull, cheapest in the group on every measure, 51% below its own historical P, and 24 of 25 analysts rated a buy. Bear has a great counter, cheap multiples on cyclical peak earnings are a classic value trap. And since the stock already sits at the analyst low of 52, maybe the market is pricing gas more accurately than the analysts are. Round 5, management. Bull, beat guidance while cutting spending, hit debt targets early, refused growth for its own sake, exactly the discipline this industry historically lacked. Bear, executives sold at 64 in March and again in June, both well above today's price. Actions versus guidance raises. You weigh it. The judge rules for the bull, but read the second half carefully. The operational execution and the balance sheet transformation are documented facts, while the bear case rests on a commodity forecast neither side can prove. But then, the bear case correctly identifies that price, not execution, determines the outcome. Translation: the bulls win the argument about the company. The bears might still win the trade. Last section, the beginner cheat sheet. What does EQT do? It drills natural gas in Appalachia, Pennsylvania, West Virginia, Ohio, and unusually for a driller, it also owns the pipelines that carry the gas to market. Biggest gas producer in the region. That's the whole business in 2 sentences. How it makes money, 2 ways. 1. Sell gas at market prices. Last year, about 2,400 BCFE at an average of $3.19 per unit. 2. Charge other companies fees to move their gas through EQT's pipes. That second one is the steadier income, because it's a toll, not a bet on price. Growing that fee side is basically the long-term plan. And the report calls this EQT's strongest story right now, which I agree with. Net debt from $7.7 billion down to $5.5 billion in 6 months. Fitch upgraded them to BBB, that's investment grade, meaning cheaper borrowing. Target is $5 billion. Whatever the gas price does, that balance sheet buys them time to wait it out. Final checklist: 4 green checks, 2 question marks, no red X's. Easy to understand, financially strong, reasonably valued, risks understood, all checked. The question marks are honest ones. Growing business gets a maybe, because volumes grew but revenue and profit fell. And needs more research. Go check the hedge book for 2027 and how many of those 45 demand projects are actually signed. Let's land it. 5 things about EQT. 1. It's the biggest natural gas producer in Appalachia. 2. It owns its own pipelines, so it doesn't pay tolls its rivals do, a genuine structural cost edge. 3. The headline revenue number is distorted by hedge accounting, so watch volumes and free cash flow instead. 4. Net debt fell $2.2 billion in 6 months and earned a credit upgrade. And 5. The one that matters most, everything rides on the price of natural gas, which management cannot control. Cheapest stock in its peer group, trading at the analyst floor, for reasons that are entirely about a commodity price. One more time, education, not financial advice. Do your own research, talk to a licensed advisor before risking real money. Like, subscribe, and I'll see you in the next one. Peace.